Good afternoon, this is Brad Dennis with BIS Commodities with your week in review for the first week of May 2018. Starting off with corn, December corn finished the week up approximately 6 cents at $4.20 and a quarter. Last year our price was $3.85. Now a couple reasons for this going on. First of all, there's a bullish attitude because of dryness in Brazil. Their safrinha crop could use a rain. There are some rains that are factored in down the road, but those are in the longer term forecasts, and until they get pulled up into the 1 to 5 day forecast, there isn't much credit to that forecast. Also, we're looking at bullish technicals. It looks like as of this afternoon, open interest in corn was up to 60,000, 186,000 as of Tuesday of this past week. If you look at the open interest rise for the past couple days, you'll see that that's up over 50,000. So we could have just added another 100,000 longs into this market over the past few days. That's money flow coming in there. That's higher highs, higher lows on a daily basis that is helping keep the technicals bullish. The other factor going for corn right now is that on Thursday we're going to have a monthly supply and demand report out of the USDA. This year our carryout number was 2.18. They expect this year's crop, along with the 88 million acres that we received from the planting intention report, to come in at a 1.6 carryout. Now that is right around a level where you will see 440 corn get traded over once, at least I would imagine. That's kind of the number. If we're under 1.7, we typically don't see 440. If we're over 1.7, if we're under 1.7, you typically can see us trade over that 440 level. If we're over 1.7 and carry out, not so much guaranteed there. It's not that we're going to run out of corn or anything, but we are depleting our supply, and that's what the trade is worried about. Also, they're concerned about inflation issues coming out there. We've seen the bonds, yields on bonds go up. We've seen the dollar increase in value. That's trying to take care of inflation, but we've also seen crude go up as well. And if you're playing the inflation play, these commodities, corn, beans, and wheat, actually have been lower priced. So we'll see some money flow into those. As far as beans are concerned, we've actually not seen any buying out of China as of late, and that's causing prices to slack some. November beans are down about 10 cents for the week. There aren't any planting issues with beans, but it's interesting to see that July NOV spread finally get back down to about even money. And that basically is telling us that we're not seeing that demand on the front end anymore, hence China not buying. Beans are always going to be played out for headline risk, such as the trade delegation over in China. The news stories that come out of that will move beans, but over the long haul, you have to look at the numbers, and we're looking at beans with 89 million acres coming out on Thursday. We're looking at possible demand issues because of these tariffs. All these things are adding up to not only staying at that 500 million carryout, but possibly adding to it. Some analysts have a 770 million carryout for beans. We'll have to wait and see, but there's a heaviness to this bean market. The lone wolf that's actually bullish is kind of the meal market, but we are seeing that back off. It has a tough time sustaining over 400, so without meal taking another leg up, I would imagine that bean prices should relax some. Over in the cattle market, a little confusing right now. You've got a $20 basis on the cattle market. We've seen 24 to 26 or 124, 126 cash trade this week, yet we're looking at June staying at that 105, 106 level. We're seeing boxes increase in value this afternoon, up 74 cents at 228 choice, 209 and a half on select. Yet we're not seeing the board able to rally with those. It's stymied some. We all know about the numbers that are out there, and we're just waiting to see if that does come into effect. It's obviously affected the board, but the cash price and the box price have not been affected by those numbers. Also hearing that this week we did have a pretty significant kill of 640,000, so we are going through a lot of cattle. Now, if we keep these higher numbers on cash, keep these higher numbers on boxes into about the third week of May, I would imagine you're going to have this June market start to converge to the upside, and could make for an interesting upside move. As far as hogs are concerned, it seems like they're stabilizing. Cash prices have been to the upside over the past 2 weeks. Now we're starting to see those stabilize, and we're not seeing those gains. So we're just kind of a little bit stagnant in that market. Over in the crude oil market, energies are much higher. This week we saw a build in crude and we saw a build in gasoline stocks, yet our distillates were much lower. And the way that the crude oil market is being played out is everybody's listening to OPEC. Nobody's listening that China, which buys their oil from Saudi Arabia, is cutting back 40% on what they're going to buy. Nobody wants to hear that because that's a ding to demand. They're just looking at that flat price, and with Brent hitting 75 today, the U.S. just a little ways away from 70 bucks. Maybe we have to make that accomplishment before we actually pull back and look at where oil production is and oil supply is. But I will say this, that the higher oil price is definitely starting to hit demand. Rigs are coming back online, so we should have very good production in the U.S. Also, looking at this oil spiking up over the past few days has helped out the stock market. Fairly neutral on the non-farm payroll report today, but the higher crude oil prices tend to reflect in the energy stocks, and with those moving up, we've seen the stock market rally. We've also seen some confidence in some of the NASDAQ companies, and that has helped out over on that indice as well. One thing also that just to keep in the back of your mind, while everything is rallying up here, we are seeing the U.S. dollar rally against these other currencies. And the U.S. dollar on the dollar index is at its highest level it's been this entire year. Now, we went through the FOMC this week, and it did nothing to change the attitude that we will have rate hikes down the road, possibly even adding more. So, with that in the back of traders' minds, there's a little bit of an inflation play out there. There's a little bit of money flow into some of these commodities, and we're seeing that at this time. 10-year note still under 3%. We were over it for a small amount of time. I think the next time we get over 3%, we do extend that a little bit more. And that's what should be happening in a raising interest rate environment. So that's a review of markets for the first week of May. End of broadcast.